Well, let's continue with our special series Quarter Se Quarter Tak as we prepare you for the upcoming earnings season. We've got Gaurav joining in. How the first quarter could be for the banking sector. Over to you, Gaurav.
Well, yes, investors' interest in the banking segment is rising, and the reason being that if you look at Bank Nifty, it recently reached its all-time high level. But when we look at Q1 numbers, can we expect the same numbers from Q1? So let's understand a few factors. RBI has now delivered rate cut in the range of around 100 basis points. On the other hand, when we look at system credit growth, that has come down to around 9.6%, which was as high as 20% just a year ago. And considering all these factors, now there are two concerns specifically for the bank. First is that slowdown in the loan book growth, and second is the slowdown in the interest margins. First, let's understand the loan book growth aspect. From what we have seen in the provisional update, we have already seen that banks, large sector banks like Kotak Mahindra Bank and some mid-sector banks like Bank of Maharashtra have delivered very strong growth. But on the other hand, we also have Instl Bank, Union Bank, who reported weak set of numbers when it comes to provisional updates. Now, considering this factor, if we look at the small finance bank, there the picture was actually even more bad, because excepting AU Small Finance Bank, there were some banks who reported very weak set of numbers if we compare it with its weekly previous average levels. And specifically when it comes to the asset quality also, there also we saw some concerns because bank like Equitas actually reported very sharp spike in their retail slippages. Let's also not forget that there were also banks like CSB who outshined because of their gold portfolio. So that was another concern which was there from the market, but it was not seen in the CSB bank. But from the NIMS point of view, we may see some kind of pressure because of all these activities which are happening. NIMS are expected to go down almost by 8 to 30 basis points. In fact, we have got a list of banks. For example, when we look at some banks like SBI, Bank of Baroda, PNB, and a bank in the like of Axis, we may see NIMS going down in the range of around 10 basis points. For bigger banks like HDFC, ICICI, and for the banks like Federal Bank, the NIM drop down can be somewhere in the range of 15 to 20 basis points, and it will be higher for the banks like Bandhan, RBL, and even for the bank like the small finance bank, where we have seen unsecured portfolio which is higher, and now these banks are actually shifting their focus to the secured portfolio. Let's also not forget that for Instl Bank, we may see an uptick in the net interest margins on a sequential basis because there was a one-off in the last quarter. But let's also not forget about the asset quality concerns. When we talk about asset quality for slippages, Q1 is usually slower in terms of asset quality, and that is the reason we will be watching out on ICICI Bank, HDFC Bank, in fact in SBI as well, because we may see some uptick in slippages. On the credit cost front, there will be some pressure on the banks where we have seen asset quality was deteriorating, specifically in the likes of Bandhan Bank, RBL Bank, Instl Bank, where we may see slippages and credit cost remaining higher despite being a drop on a sequential basis. Now, let's not forget that for Axis Bank, they have actually tightened their norms, and that is the reason we will be watching out on slippages as well as credit costs for Axis Bank. Lastly, considering all these aspects, when it comes to the earnings, we may see some drawdown in earnings as well. For PSUs, there may be some gain, but for the likes of HDFC Bank and ICICI Bank, we may see the momentum somewhere remaining around in the single digit when it comes to EPS growth. And for the banks like Axis Bank, SBI, and even for the bank like Kotak Mahindra Bank, we may see some drop. For the banks where we have unsecured exposure, we may see a bigger drop somewhere in the likes of around 20 to 30% for Bandhan Bank, RBL, and even higher for Instl Bank. Now, considering all these aspects, do we really are concerned about the overall outlook for banks? Well, it is unlikely, because when it comes to the outlook, many of the investors believe that this is going to be an event only for a quarter or two. In fact, Macquarie recently wrote a note where they believe that there will be some uptick in the bank's net interest margins. In fact, they believe that in FY27, we will see NIMS actually recovering to the full extent, and the private sector banks can also grow their EPS at around 15% over the next 3 years. So definitely, there are a few concerns in Q1. We may see some slowdown, but that does not mean that the banks are going to lose their shine. And on the back of that, we will be watching on the sector in coming days.
All right, Gaurav, thank you very much. Very comprehensive QSQT and banking. Ajit Kumar is lead BFSI research analyst at JM Financial Institutional Securities is with us. Ajit, good to have you with us here. Thank you for your time. So across the board, I think as Gaurav comprehensively outlined, there is decline in margins, which is expected, some bump up in credit costs, etc. as well. How do you approach this season? It's going to be, of course, when we know, we'll know, but these are largely modeled in since NIMS will be lower because of course, rate cuts, etc. What's your sense?
Yeah. No, good morning, everyone. I think, Gaurav has summarized this, beautifully. Gaurav is absolutely right. We have the latest credit growth data till 27th of June, 2025. Now, the interesting point is YTD credit growth is roughly 1.3% versus, let's say, 2.8% last year. So credit growth definitely is lower as compared to last year. And on top of that, there is a margin compression which is going to happen across the board. Let's say, for the large banks, we are expecting roughly 10 to 20 basis point of margin decline in 1Q. Even in second quarter, there should be at least 10 to 15 basis point of margin decline in second quarter before recovering, let's say, by fourth quarter of this financial year. So net, because of this moderating loan growth and let's say margin compression, NII growth for our coverage banks, it's not more than 2 to 3% on a YOY basis. And 1Q is normally seasonally weaker quarter. But even if we adjust for the seasonality, my sense is 1Q is going to be even more weaker quarter for the most of the financials name. On the asset quality side, yes, slippages are going to bump up because in the large bank, there is elevated agri slippages that come in first quarter. And on top of that, you have unsecured loan, which is a bit of pain still now. So net, your credit cost is going to be higher. So combining for all the banks that we cover, the PAT growth is going to moderate to roughly 8 to 9%. Versus, let's say, 6% decline that we had seen in fourth quarter. So this quarter as well, we are going to see, PAT declining by roughly 8% on a YOY basis in 1Q26.
All right, well, that's just hold on to that thought. Ajit, we have a newly listed company, Travel Food Services. It lists at a bit of a premium in comparison to what the IPO price is. And there's quite some ringing going on there with regard to that bell. So, management sounded optimistic about growth, profitability, and ROCE of, I think, 50% is what they were mentioning as well. The hugs are there, a green listing out there. I think the grey market premium had come down a little bit, but the stock opens up in the green. So I think, those smiles are quite bright and broad out there.
Yeah, I think
and the ring was quite something.
Yeah, I'm sure there'll be some good food as well at that listing ceremony.
Better be.
Well, that's Travel Food Services. They offer, of course, food and beverage services at many airports. Big
All
airports.
the youngsters as well, quite happy to be part of that.
Yeah, it's one big happy family there at TFS as the company makes its listed market, public market debut today. We'll keep an eye out on how that share behaves as the day progresses. But just to get back to that conversation on financials with Ajit. Ajit, so, okay, let's just break it down in terms of, first of all, from an investor's perspective, should we be, when we're watching out for the biggest delta, should we be looking at the biggest growth outliers? And in which case, which could those banks be? I think the consensus is tier 2 banks will probably be tier 1 banks when it comes to growth. And when it comes to the margin delta, perhaps the best margin performance, the least drop in margins, etc., then which could be 2 or 3 of the banks which could surprise on the margin front? So tell us both.
Yeah. No, I think on the growth side, some of the smaller banks have done relatively well. Like, for example, EU Small Finance Bank, they have reported, good set of numbers, especially on the growth side. My sense is PSU banks, YOY growth is going to be higher as compared to private sector banks. And this has played out in last quarter as well. Even in this quarter, the banks who have reported their numbers till now. For PSU banks, YOY growth is roughly 11% versus, let's say, 6 to 7% growth for the private sector banks. So PSU banks are growing faster as compared to private sector bank on a YOY basis. And then even on, let's say, some of the smaller bank side, let's say, for example, EU Small Finance Bank, Karur Vysya banks, those guys are delivering, better on the growth side. Now, on the margin side, my sense is some of the mid-sized bank like City Union Bank, where most of the loans are fixed rate in nature, their, margin decline is going to be lower. Then some of the large banks, margin decline is going to be somewhere in the range of 10 to 15 basis point. But for the other banks, right, like, for example, all the other mid-tier banks and small finance bank, our sense is margin decline is going to be even more sharper. It's going to be somewhere in the range of 30 to 40 basis point. And the reason for this is there are 2 drivers of actually, this margin decline. One, obviously, the, policy rate cut that has happened, let's say in last, 2 to 3 months. The second issue here is mainly because of this stress in unsecured loan. Most of these mid-sized banks and NBFCs are getting into secured loan all at the same time. So everybody wants to get into vehicle financing. Everybody wants to do affordable financing. So what is happening is there is a loan mix shift which is happening from unsecured to secured. And that is putting pressure on the yield side. So there is a mix shift which is happening from unsecured to secured. And as a result of that, there is elevated competition in the secured loan. So there is a pricing pressure as well in some of the secured segment. So yield is coming under pressure, and that is why we believe that for mid banks and NBFC, the margin outlook is even more muted. But coming to your question on the margin side, our sense is City Union Bank and large banks are going to surprise positively, or at least their numbers are actually baked into the expectation.
Okay, and very quickly, your top picks then? Just quick 30 seconds.
Yeah. So, ICICI Bank continue to remain our top pick. ICICI Bank, SBI, even Axis Bank remains, our top pick. In mid banks, City Union Bank and DCB, continue to remain our top pick. In NBFCs, we like, Bajaj Finance and PNB Housing Finance.
Okay. All right, Ajit, thanks a lot for joining in and giving us that view. We look forward to chatting up with you as the numbers keep trickling in.